Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, and it is September 3rd, 2025. We're coming to you live at 5 p.m. Eastern, as we typically do on Wednesdays. And we've got a lot to talk about today. It's been an interesting market, and to help us kind of figure out what's happening and what kind of style we should have, it's Mark Ritchie II. He, of course, works very closely with Mark Minervini, has for a number of years, featured in Momentum Masters, and an all-around great guy. So welcome back to the show, Mark.
Well, thanks, Justin. Thanks for that intro. Good to be back. Good to see you.
Yeah, good to see you too. So let's get right into it. I mean, this market, we've had this nice trend, but it's been very, very interesting. Especially right now, a lot of potential rotation, a lot of kind of angst over macroeconomic, whether it was tariffs or the Fed, inflation, labor markets. There's just a lot of, I guess, still uncertainty, and the market has pretty much shrugged a lot of that off. But it's been very hit or miss with individual stocks. You're either doing great because of the stocks that you have, or you're getting frustrated because the stocks that you have aren't moving. So I guess the first question for you is, how do you handle that frustration when you're on the winning side, and maybe the humility, when you're on the winning side, and you're like, oh, I need to be a little bit cautious and not get too full of myself?
Oh boy, a really good question.
Right, that's the opening question, and then we'll pretty much call it a show.
Yeah, that's right. Yeah, I mean, we could probably spend the next 45 minutes talking about this.
Yeah.
And look, I'll put myself firmly. It's sort of in. You use sort of two camps. I'll put myself in the tempted to be frustrated camp because this has been a more challenging year for us. Look, the reality is, or if we wanted to call this maybe this segment, something, it would be like, so you want to be a trader, so you want to be an investor. You have to understand, that there are going to be good days and bad days, and periods where it seems like money. I've said before, look, there have been periods that felt so good, or seemed so good, it was almost though you had a printing press in the office. And then periods where you just feel like you're spinning your tires, or man, am I gonna make another winning trade? So how to deal with those periods? And
Is this the job for me?
Well, right.
Yeah.
And listen. In the early days, I don't know that I've known successful traders, in any strategy, that haven't had those gut check times, especially in the early going when they were trying to really figure things out and get over the hump, if you will, or get to a point where they had real confidence in what they're doing and in themselves to actually execute. So, we can go down any one of those little rabbit holes, trails if you want within, what I was just talking about. But I think it's an extremely important topic. And listen, if you get on social media, those type of things, you'll never hear too many people talking about difficult times because everybody just makes money every day.
It's just that easy, right? Yeah, they don't do anything wrong.
Why would you talk about losses?
They always have the winners.
That's a buzzkill.
Right.
I've been talking about some of those things a little bit, but happy to go wherever you want with the conversation from there.
Yeah, and I should mention that you've put some really great posts on X here. So for those that maybe aren't following you at this point, at Mark Ritchie _II, so Mark Ritchie II, and maybe we start with the comparison thing, because you said on one of your posts, comparison is the thief of joy. And I mean, I certainly, when I've got 3 kids, the 2 teenage daughters growing up during social media, really starting to get figured out and all of that. And that was the biggest thing, right? Comparison. And with the market, I mean, of course, everyone compares themselves to the S&P 500. It's very easy to compare yourself to the folks on X as well. But what to you is the best indication that you are on the right track, following your rules, and doing what you need to be doing?
Yeah, well, I think one of the first things would be that you're not You're not comparing yourself with anybody else's performance or even with their ideas or what they own. Because listen, in this business, if you don't own your own stuff, your successes, your failures, your mistakes, all that kind of stuff, you're just probably trouble waiting to happen if it hasn't happened already. To your point though about, okay, let's talk a little bit about, constantly comparing yourself to other people. I'm not saying that we shouldn't look to emulate those who have gone before us. Obviously, we're on IBD here for a reason. I've read O'Neill's books many times, and guys like him and Minervini and David Ryan, and we could list so many others. There's a reason why we gravitate towards certain things. What I'm referring to though is sort of that unhealthy comparing, and you use the example, say when you have kids and that type of thing. Look, don't compare yourself to your brother, your sister, or whatever. We're talking about you. If you've ever had a conversation with a kid about anything, because what winds up happening when we do that is we're never focused on where the real problems or the successes are, which is within us in terms of, and look, as the reason we own our own results in this business is who else is going to have them? Well, you can't give your losses. Nobody wants to give their gains to anyone else. They'd love to hand their losses off, but that's not how this works. And there's two sides to the coin. The reality, of course, is the gains have a way of taking care of themselves if you manage the downside. But it's that managing the downside part is often quite difficult. Candidly, with all the cards on the table, it's like, look, we're down a few percent right now, but we're sitting right below all-time highs. Where else will you want to be when things aren't going well? It's been frustrated, and we can get into, have we made mistakes? Have we broken rules? All the answer is no. But how do you deal with that situation? Well, I take a step back. I go, what does it matter what other people are doing? And actually even coming in the opposite spirit, rather than being tempted towards jealousy or comparing, saying, hey, God bless those people or whatever. I hope they're killing it. They're having their turn at the wheel. Mine will come. Because even within a strategy like growth or momentum, there's a lot of lanes on that highway where some people trade a lot more often. Some people are more position traders, very short term. I know a number of traders doing better than me this year. That's great. Good for them. My turn's going to come. I can explain why it's been more of a struggle, but the reality is if you don't get comfortable in that, you may even do well and you'll never enjoy any of it, because you're always, when times are good, you're going to wish you did better than somebody, or you did as well as someone who maybe did better than you. And when they're bad, it's even worse because, or you're flat, you're down a little bit. You're kicking yourself 6 ways to Sunday and twice on Sunday that you're not the guy who's, again, always up, rather than asking yourself, am I compounding good decisions? If I continue to do what I'm doing or making these type of risk reward decisions, because whenever you're playing a game of probabilities, inevitably there'll be periods you do everything right and things still don't go your way.
Right.
And so there's a number of things, of ditches we fall into, but the biggest reason I would suggest to anybody newer in trading or investing at all is the temptation then becomes to, maybe I should do something else rather than stick with what is a good approach. And so it's that comparing within regular life is the thief of joy. In trading in markets, it's usually the thief of returns, because what winds up happening is you chase whatever strategy's hot. And the minute I jump into, breakouts weren't working, I'll go to mean reversion. And then you start fading them, and that's when you get run over. Well, I'll try trend following, systematically, and then that doesn't work. And then I go to stat arb or whatever. I mean, there's so many other different, I'll try value. I'll try this thing, whatever's hot. Well, and listen, there's been enough written on this, but everybody has to kind of, again, go through enough periods, even within a strategy. Every strategy that's even good is going to have periods where it underperforms. That's actually a good thing if you're a good practitioner, because it's that stress point and those pain points that actually weed out the less disciplined players and those that probably aren't going to make it in the long run unless they make some of the adjustments that we talk about.
And I think that's the big thing, right? Is you have to be very careful of looking too short term and kind of losing the forest for the trees, where if your long term is okay, and again, you haven't taken a big drawdown, you're still in a position where you're close to highs, you can still get, back in the game very easily. That's a lot more important than chasing so many different things and then, letting the frustration kind of, what poker players would call, put you on tilt, to the point where now you've gotten yourself into a hole that you have to dig yourself out of, and then the problems really compound to the downside, and that's not what we want. We want things to compound to the upside, not to the downside. So
Yeah, and one thing I was, or way I describe it sometimes, is thinking about this in terms of your financial capital and your emotional capital, because if it should, you want it to feel worse than it is when you're in a losing period. Meaning, you want to be really frustrated and annoyed, but not be down much in terms of actual capital. You show me somebody who's frustrated, upset, or whatever, and is down 2%. That's probably someone who is much more likely to not just be to come out of that drawdown and be successful, but is much more in sync with their emotions in terms of the strategy and how they all marry together. And look, the guy or gal who is super confident and taking big positions when they're 25% off highs is a potential disaster waiting to happen.
Right.
Or that person that's on a string of losses and is just, they're stepping to the plate with confidence and swinging for the fence. It's like, whoa, time out. Let's take a step back here. So yeah, absolutely. And the other point I wanted to make, though, is this idea of your like if your confidence is dealt such a blow that you can't follow your process, that's when you have a really big problem. And effectively, at that point, if you're not really following a process, I hate to say this, you're probably just gambling, which means you're playing a game of chance where the odds are not in your favor, where process is supposed to give you an edge. And that at the end of the day is what gives you the most comfort, because I've done enough trades and I have a process-driven approach now where I can look back and go, well, there are going to be periods where you might be wrong 10 times in a row, 20 times in a row. But there's a large enough data set where I go, this is normal.
Yeah, and it's also important to kind of recognize that feedback when the market is giving that to you. And I know when I was at the Mark Minervini event, his birthday, where I got to meet you in person for the first time. We've chatted, of course.
We broke bread together.
Yes, exactly.
It was fantastic.
Yeah. But one of the things that he really kind of drilled, over and over, was knowing your numbers. So Mark, for you, what does that mean? What numbers do you kind of rely on in terms of your own performance? Again, if it's not comparing to other people,
100%.
What numbers is it that you're looking at to tell you, hey, am I on the right track? And how to use those numbers to kind of guide your decisions?
Yeah, absolutely. Well, listen, at its most basic, it's just as simple as knowing, okay, historically, what's my average gain loss, and then where's my win rate, both in terms of, so I like to peg the average loss, because that's what you generally have the most control over, in terms of, if I know ahead of time where I'm getting out, I can have the most theoretical control over that, of those three of the metrics. If you think of sort of the metrics as a three-legged stool, I go, that's the one I want to put the most weight on and lean on, because if I'm doing my job, I know where I'm wrong ahead of time. So I can calculate what's the worst case scenario. Now there are gaps and other things, but if you do a large enough sample, your average loss should generally come pretty close to where you plan to get out. Then I tend to be a 2 or 3 to 1 type trader. So I'm pegging my average gain then based on the average loss, and the win rate is what I have the least amount of control over. So, and that's precisely why it's been a frustrating market for me, because I have not had a high enough win rate. It's basically been hovering around high 20s. So 3 to 1 trader, you need to be right roughly 25% of the time just to kind of break even, and that doesn't account for if you're playing certain positions heavier, or smaller, or what we would call progressive exposure. So we can get into that side of it, but those are the three metrics.
Yeah.
And then I'm just constantly asking myself, look, and one of the things we talk about at Minervini Private Access, but I learned this directly from Mark Minervini, but as well as a lot of other traders, it's that idea of, look, if you go for a lower win rate, and I mean by lower, say anything 50% or lower, you're building in what we would call a lot of failure, or a lot of, you can go through periods where you're only right 20% of the time and not get yourself in big trouble. Where if you're reliant on that higher win rate, it tends to be more of a mean reversion or a market making type strategy. You can be right 50% of the time and be losing money. I want to look at it the other way, where I am even one decent winner, where your winner pays for a number of losses. So I'm one above average winner away from paying for a whole slew of losses, or I'm one period where even my batting average goes to 50% or north of 50%, and I'm making money with ease.
Yeah.
So that's kind of how I think about it. Like, how bad does it have to be? Like thinking about, again, always focusing on managing the downside, the worst case scenario. What kind of a bad environment do I have to be in where I'm really getting in trouble?
Yeah.
Which is why, for me, the toughest environments are actually not historically where the market's just falling, because I'm not doing much. I'm sure you can relate to this. It's like, look,
absolutely.
once you get into cash and things get really dicey out there, you're either stopping out of remaining positions or that kind of thing. But this idea of just taking 15 losses in a row, that doesn't usually happen. It's normally when there's merchandise to buy, it's just not working, or there are setups, but you're not getting enough follow through action to pay for the risk. And that's precisely, ours has been that smaller win rate.
And just to be clear, again, if you look at most of the successful traders over time, I don't think any of them have a win rate over 50%. It's exactly what you said. Their wins, when they have them, more than make up for their losses, because they're controlling the losses to such a degree. And again, I've in all the books I've read, it seems like it's just very rare for the most successful traders. The ones that tend to have look, I've got a 90% win rate. They're taking these small gains, to get their win rate up, and one loss can just boom, wipe them out.
They generally are either an accident waiting to happen, or it's a completely different, it's a market making type of deal where they're picking up pennies in front of the proverbial steamroller, and they're accounting for the fact that they got a entirely different problem to deal with. It as at some point they're going to take a huge loss.
Yeah,
it's the old, they eat like a bird and dump like an elephant. Opposite, where
right.
I want to do just the opposite. I want to lose like the bird and win like win with the elephant sized. So yes, I tend to, I would say of almost all the successful traders, I would tend to agree. And I've known some with win rates as small as 15%, maybe. That are really there. I think I don't know if that's the case, but somebody had said, when Richard Dennis used to coach the Turtles, he wanted them. I don't know if this is true, but he wanted them to be able to be successful with a 10% win rate. Meaning, just do the math. That means their wins are occasionally very big.
Yeah.
And then it also means their average size trade was probably pretty small, because otherwise you're going to have a really big drawdown if you're only right 10% of the time.
Well, let's go ahead and I'm going to pull up a market chart here. So this is the NASDAQ composite, and certainly, again, one of the things that was very, very nice about this market was how well we were trending above the 21-day moving average line. And then the summer hit, and there's tons of people that will say, oh well, gosh, you should have known August is bad. But you started August off in an ugly way. This was the August 1st, the first drop below the 21-day moving average line. And then it was like, oh, well, we're at new highs again. And we've just been kind of going a lot of back and forth, where it seems like as soon as you're in new high territory, you're You're getting some traction, then the rug gets pulled out from under you. Even yesterday, I mean, it looked like things were going down, but then upside reversal. We got a follow up on that upside reversal today. But that's if you look at the Nasdaq. If you looked at like the equal weighted, um, that gain wasn't there. That was Google and Apple.
Right.
So very narrow in that regard. So how do you kind of do you use the indexes that much, or is it just a matter of I've got to look at what individual stocks are doing, what the merchandise is doing in order to make your decisions?
Yeah, it's the latter, 100%. In fact, uh, and I usually tell people, don't even, if you're new, don't even put the indexes on your screen, mainly because that's what they're measuring themselves against. And like you talked about earlier, we didn't mention benchmarking, but I did recently post even something on X about this because I got a question on it and I thought about it and I go, I don't think I've ever looked at my performance over any period of time and then said, what did the S&P do? In fact, if you were to put a gun to my head and say, tell me what the S&P did, or I'm pulling the trigger, I'm probably a dead man because I don't know. I don't watch that kind of thing. It's just not how I think about it. And
It's not one of your metrics.
right. Well,
Yeah.
it's just an index, You made a really good point though earlier saying if you're trading your own money, like what are we doing? Your goal is to compound wealth and to improve your financial position. What does it matter? I've had periods where, over the long haul, I've beaten the S&P by a wide margin, but like I know that well after the fact because my goal is to sit here and compound wealth, not worry about what the S&P did. Now, this is a perfect example in terms of why this matters or doesn't, and I'll throw out a few scenarios. So I'm looking at the stocks. And look, it has been a more selective environment. You just highlighted it pretty well, even over the last, say 3-4 weeks. Okay, how much of this pullback, versus holding up and how well things have done, we can get into the Russell. Money has rotated there, which has been a good sign. But has there been stocks that are really working? In August, like you said, seasonally, not the best period. I could make a really strong argument, though, that the best setup may be yet to come.
Yeah.
Meaning even for this period of the market where, and I did not get much in the way of progress or traction all the way up this right-hand side. So this is a classic lockout rally where the index takes off, leaves everybody in the dust. Well, is there a reason to think that we may not have an extension? This reminds me a little bit of COVID. The difference in that period was I was doing well up the whole right-hand side, but then if you look, the market then, we had barely a 5 to 8% pullback, I think, until September. Very similar, even seasonally, where it bottomed. Of course, you're bringing it up. Perfect. Right. Yeah. Right there. Okay. I mean, much bigger decline, but that whole run up the right-hand side there, we didn't get a bigger pullback until we were in new high ground. I mean, even going, pull it forward a few weeks or months if you can. Go to December. I think I made more money coming out the last 2 or 3 months of that base because then we had tons of a lot more. When the market did that over those corresponding month and a half or 2 months, it set up tons of follow-up buy points. So if you'd missed names, you were able to get on board or play catch up, for lack of a better word. I don't think of it that way. I just think of I want to get into new high ground for what I'm doing. And I got to stay close to those levels. But the reality is the best setups in some cases, I mean, it was October, November, December, January. I made more money in those 4 months than I had, maybe I might have doubled the return. So listen, and let's just have people ask themselves, what if we had a whole bunch of ideas in 3 or 4 weeks or 3 or 4 days, doesn't matter, but we get a bunch of new setups. How many people are going to be tempted not to buy them because the market's come a long way off the bottom? That's the trap, in my opinion. They ignore their process, which says either buy more, get longer, because they're concerned about what the S&P's already done.
Yeah. And, it's also, you mentioned that, how strong it was going through January, February. And this is one of those tricky periods where a lot of the growth stocks really topped in February. The indexes kept on going, but growth. I mean, like again, if you had looked at ARC,
The Arc
RK,
Innovation, yep, great
yeah,
one.
the Kathy Wood Fund. I mean, February was the top, and that was the beginning of a 70% plus,
Nasty.
drop.
Yes. Well,
So,
and there was a good example where, okay, 21, and I knew a number of growth guys that did not have good years in 21. I had a good year,
mhm,
um, because one, I stepped out of the way of some of that, and then there were some trading opportunities, and things didn't really get narrow to the end of that year. Because I
yeah,
can remember, I think by the end it was like you said, small caps rolled over in February, and then it was other stocks that summer, and by the end of the year, there was hardly anything left. But
mhm,
again, if you were just taking your cues from the index, you'd sit there and go, why have I been doing so poorly? The index isn't the full part of the story, and
mhm,
this is where you have to have a process that allows you to read through some of those things. I'm saying right now, this rally's been more narrow. Have there
mhm,
been pockets in areas that have worked? Absolutely. And have I owned some? Yeah, not heavy enough. That's the other part, in terms of if you're going to use a risk management style that is not equal weighted, there will be periods where you are heavier in names that don't do well and lighter in names that do. We kind of call it, you have the zigzags, you zig, the market zags, or you've got your eggs in a lot of your eggs in one basket, and that basket turns over. Uh, that is a feature, not a bug of
mhm,
progressive exposure.
mhm.
But
Yeah.
you have to be surrendered to that. You have to be okay and say, well, I'm sacrificing the equal weighted portfolio. Well, that's the way we do things. And
Mhm,
every time this year we've gotten aggressive in a name, we've wound up having to scale right back. Anytime
mhm,
we've ramped up really fast, we've had to quickly move from the gas to the brake.
mhm.
That's again, that is a feature of that type of risk management, money management.
Mhm. And some people are asking on YouTube, again, just as a reminder for folks, you've been working with Mark Minervini now for 10 years. Has it been that long? Over 10 years?
Wow, what do you mean by working?
Okay, yeah. So yeah, I mean, you
I
have a
have been
great
a,
story.
yeah, I've been a
Uh,
student of his for over 10 years.
yeah.
Yeah, we've been helping on the platform since around COVID times. So
Okay.
right around 5 years.
Right. Okay. So 5 years and a very interesting 5 years, of course, with that and some phenomenal performance. Would you consider yourself more of a swing trader, position trader, day trader, all of the above?
Definitely not a day trader.
Uh-huh.
So yeah, never really been a very short-term trader. Or what I'll generally say is, if I'm day trading, it's because I'm losing, or I'm like
Right.
getting out of it. I'm punting a stock that's not doing what I want it to do. So it's a day trade.
Yeah.
I tend to be in that trader where I like to sell a portion of the position, and then use that to finance a longer swing trade or a position trade.
Hmm.
And lately, it would have been better if had I just short term traded out of entire positions. And early in my career, I predominantly just a shorter term trader, not day trader, but meaning I was just trading into the first move and compounding gains.
Right.
And it
Yeah.
wasn't actually until learning from Mark and David Ryan, over the years, different techniques, or okay, why should I consider holding a piece of this name? And then I was actually studying my own data,
Hmm.
because I had hundreds and hundreds of trades, and noticed that, and I think I've shared some of this before, but it probably bears repeating, that my biggest the trades I was selling that then went on to have these big moves were all the things that O'Neill talks about in his book, and that Mark talks about in his book. They were coming out of some of these classic areas
Right.
that have some of the earnings, either earnings or sales coming out of certain areas of the market. And I was like, okay, wow, this is powerful information. So
Yeah.
on occasion, especially coming out of corrections in different periods of the market, I should be looking to play some of these, or trying to play them for a bigger move. The difference is I don't necessarily decide that ahead of time. Try and let the stocks pick me. So
Yeah.
I buy something, it blasts off, and it has good earnings on the table and all of those type of things. Okay, I'm willing to try and give a portion of the position a benefit of the doubt, or what I would call trade to invest,
Hmm.
versus most people do the exact opposite. They start as a trade, it doesn't work, and they go, well, I'll hold it a little. They let the losing trade turn into an investment. I
Hmm.
want to let winning trades turn into an investment.
Yes. Yeah. Yeah. The famous last words is, "Oh, now I'm a long-term investor," right?
Yeah,
When it's not working, that's when they say, "Now I'm a long-term investor."
exactly right. Exactly right.
Yeah. Well, you know what? Let's talk about, because again, if you got into some of these names, early on, it was easy, right? They just trended so nicely. But if you weren't in them early, as you said, some of them just didn't give you the chance to get into them. You had all these gap ups. It's if you were in it and it gapped up 20%, good for you. If you weren't in it, then, well, now that it's gapped up 20%, what do I do? So maybe we start with something like a lab. This is one that I've been stalking, and I participated in maybe, this tiny move here, and the rest of it has been watching from the sidelines. So I've missed out on this gap up. I've tried it a couple times in here because I'm looking at this, flat action, that it's doing, kind of like, a high tight flag maybe. So walk us through, something like this, how you look
Absolutely.
at something like this, because again, this was a pretty nice base. It had all of these attempts though that failed around 100, and then the one that worked, right? But then it gapped up and it was kind of out of there. So
Right. So there's the perfect. This is a great example of a stock where I look at, and I haven't graded this yet, but what we will, because I've done two trades in this name, both losses, and if I look back, I would go, I wouldn't grade them as like exceptional buys, but they're absolutely acceptable. First was you in June there, one of its first attempts, kind of going over 100,
mhm,
right in there. Yep, I was buying that day, and I either sold, I think we sold half the next day and sort of staggered a stop between the next 2 days, got right out, didn't
mhm,
go. Now that if we were to sort of zoom back, is not the best setup because but it's an acceptable low risk
yeah,
entry in my mind because you are going into quite a bit of overhead supply to the left.
mhm,
But I was thinking, okay, if the rally is going to continue and it's going to broaden at all, because initially, and you mentioned, like, and we could have looked at Robinhood or Palantir being two, that if you weren't willing to be aggressive with sort of like short, little stunted handles or buying a gap through one, you missed them.
mhm,
And that was me. I missed. I didn't even play them. Well, so I looked at this going, all right, maybe that theme, money's gonna spread to other areas. This still had triple digit earnings on the table, looked really good. I figured, all right, we'll give it a try there. It failed. To your point, I'm not gonna chase that gap then, 4 weeks later when it comes out. I was
mhm,
watching it, but it gapped, got away from me. Okay, then I tried it last week, small position out of what would be some type of high tide flag. Yep, kind of right there. And I took a smaller than I would have wanted, hoping it's either going to tighten up and I can add to it. And then I got stopped out on yesterday. So
mhm,
I, I would look at both those trades. Now, to your point, it's a different type of trade. It's more of a pure kind of momentum. Okay, this is a high tight flag. It looks really good, or what we would call a power play. I want to see it tighten up more. It still may, and I'll
yeah,
step back in if it tightens up again. But this is that sort of. So you want to be a trader? Look, I'm looking for low risk and way to get on board. I took
mhm,
tiny little losses both times and missed. But that's where else are you going to get on board? Anybody can look at the name and go, oh, I should have bought this. But where were you going to buy it? And where are you
mhm,
going to buy it? Where if you buy in such a way where you ask yourself, if I made buys like this 1,000 times, does it have
mhm,
real positive expectancy? Well, in a name like this, triple digit earnings, in the semi group, we've got the long term uptrend and we've done all those things, put everything, stacked all these probabilities in our favor, and I make low risk entries. I am confident over time. I have positive expectancy because I have hundreds and hundreds of trades where I've done just
yeah,
that. So it's a function of how the market's been treating my tactics right now, but that doesn't mean they were
mhm.
bad.
Yeah. And I will say that, I mean, I pretty much did almost the same thing here, except I think I had another trade right here that I tried, and then, got out right there. And it was the people that went on this day or this day, it seemed like, that was like, oh, now I'm golden. You got
Right.
the gap up, you were able to hold through earnings, and it's no problem. But I think I was getting in here, and, then sold before earnings because I just didn't feel
Well,
like I
and
had
look,
enough of a
even
cushion.
that whole run up there, and look, we've seen a number of these and of stocks that just took off up the right hand side, and this one, like you said, really, I mean, even last week's little entry there, it's a little sloppy in my mind,
Mhm.
but it's been so strong,
Yeah.
I'm willing to go, okay, I'll cut it some slack and see if I can get involved. But okay, this
Mhm.
stock could easily, within a week, 2 or 3 weeks, maybe 4 or 5, it puts in a whole base up here and is a
Yeah.
higher probability situation than even the other two that I played. Because if this stock can
Mhm.
really base up here and you get a nice volume dry up, this is really going to be the first, or second viable base. If we want to call that one, like you said, that gapped out, we may just have another base right here. So that's really what I'm
Mhm.
watching for.
Mhm. You mentioned Palantir, and so this is another one where I feel like there was this kind of early entry here that's not your typical, but it certainly wasn't one where you're like, oh, you're way out there, you're crazy,
Right.
and
But
here
that was
again it
also,
felt like people.
go
Go
ahead.
ahead.
Go ahead. Sorry.
Well, yeah, I felt like people that got in there, quickly got that cushion. But look, you were tested. You were tested pretty quickly, and you had earnings there. So it certainly this is one of the stocks that we've been talking the most about. But this one hasn't been easy either.
Well, and like you nailed it. Look, the one time I did try it was a little bit later through that what became sort of an obvious little pivot. Yep, right there. Not sorry, not there. A couple days or couple weeks forward there in late
Oh, okay.
May,
Yeah.
right there.
Yeah.
And then of course it rinsed and went again. But to your point, early on, that little gap up.
Hmm.
I mean, this stock had a 40+% correction, was still running
Right.
into quite a bit of overhead. And,
Yeah.
yeah, you would have, to me, I've never chased a gap like that. So
Hmm.
that's an easy one to say, listen, I'm going to leave that for someone else. And
Hmm.
I think I don't know if we mentioned this off air earlier, but it's like, look, I know plenty of traders who've been successful in sort of growth and momentum buying gaps, but I'm not one of them.
Hmm.
So,
Yeah.
like that's not a part of my toolkit.
Hmm.
And if I'm gonna buy a gap, it's a small gap, and it's coming through a pivot or setup that I would be buying if it didn't gap, and the gap is acceptable above where the pivot would be. So it's very close to where I would otherwise be buying the position. That this is just not. I wouldn't have played that pivot probably to begin with, and then the fact that it gapped, and I think if you measure the width of that pivot, it was something like 8 to 10%. It wasn't very tight. So
Hmm.
yeah, that's the sacrifice. I
Yeah.
often say you can be disciplined or own everything you want, but you can't have both. So
Well,
I'll
and that's also kind of the idea behind the jack of all trades, master of none. If you have all these tools in your tool belt that you use all the time, then do you really know when to apply them and make the most out of them? Are you specializing? And look, again, I think you and I both have seen so many traders do things successfully because they kind of have their thing that they know backwards and forwards. But it's tough. It's tough when you're like, oh, I'm gonna do this. Now I'm gonna switch to this. I'm gonna go from swing trading to position trading to to shorting, and all
right,
of that.
right.
So,
Yes,
um,
100%. And yeah, there's been, I mean, any number of examples like this one.
mhm. Yeah. You know what? You mentioned Hood. This has been another one that's been just really kind of tough for me. And again, it looks so obvious in hindsight, right? Where, oh well, if you just bought right here, but as you mentioned, this was another one had a lot of overhead supply. And who would have known that this was going to be the one that really worked.
Yeah,
It,
if I'm
it,
going to
it
kick myself on this one, like, so again, that pivot you just highlighted there,
mhm,
is usually sort of a no go for me because one,
mhm,
it's got a ton of overhead still, and it's short, and then it gaps. So it's sort of like
Yeah.
you're stacking things I don't like on top of each other, and so it becomes a deal breaker. But a few weeks, that short little handle up there in May, if I'm gonna really be a stickler, go right up there. It wasn't very long. That was viable, and given how strong it was, if I'm going to fault myself for not owning Hood, that's the entry I would take if I'm going to stretch. That's what a stretch looks like for me. It's short, but it's really strong.
Yeah.
Now I don't generally. So the other thing I will say, if I'm going to stretch, it's because things are jamming. So that would be a situation where if I'm if I'm doing really well, which means I'm at new highs, and I'm in positions that are working. I've got some P&L in terms of open profits I can lean on or cushion to lean on. I'm willing to go out the risk curve a little bit. Okay, we're talking, what is that? A pivot of 1, 2, it's not a base. It's a 6 to 8 day pivot, if you will, sort of right at new highs. It's a short handle. I'll play those in really high RS situations. Well, this was one of those. So that was absolutely viable per my rules. But given those other factors I said in terms of, I didn't have a lot of cushion in other places and wasn't, I use the baseball analogies. I wasn't seeing the ball real well. This is like, okay, I'm going to swing a little bit outside of my normal sweet spot, but I'm still in the strike zone. It would be a setup like this for me. Well, I wasn't raking it in terms of, in my bread and butter trading. So I'm not going to go out the risk curve.
Yeah. And look, I mean, even that, if you kind of call it handle-ish, we typically like to see at least flat or drifting down. This one was not really doing either one of those.
Yeah, a really good point. That was a 1 day drift down there.
Right, exactly. 2 days. Yeah.
Handle-ish I like that term. You should coin that because we're being generous to really call that, a well-built handle.
Yeah. So, just because again, things haven't clicked exactly, it doesn't mean you give up and you don't look, right? You're always looking. You're always looking for the next setup. So maybe we could talk a little bit about some of the things that you're watching. So we just went over some of the, clear-cut leaders, of this last rally. And are you looking at, okay, these have moved a lot, but they could still go. How do I get into them? Or is it like, I've got to look at these other areas and, the new merchandise, what maybe is, again, we keep going back to the rotation idea. Do you go to some of like the home builders, or things like that, more of the small caps, things that have just started coming up, even above their 200-day moving average lines. So where are you finding your setups are gravitating towards right now, the things that you're watching?
Yeah, it's a little of both. And listen, right now, so for starters, let's just talk about, okay, the names that have really ripped. A Robin Hood. Look, this could, if you really count that high in July, I would count that sort of the start of building a base. It made mild incremental new highs. We're working on, on a base in here now. So if this can give us there's no right side, but if this can give you a right side, or we get some type of volume contraction, I absolutely be interested in a name like Hood. Or Palantir or they're going to need to form bases now. So can we get constructive bases? That's where, listen, that any names you miss, I rather than if you missed it, rather than kicking yourself about it, just put it on a watch list and see. There's been so many names I've missed, they've doubled, and then I buy them later and make money on them. So. Yeah. Listen, the stock doesn't know your name. It's not, it's not
out to get you.
It's not waving a finger at you saying, "Oh, look at how bad you missed me," or whatever. That's not how this works. So, I obviously whatever's been the strongest is where I want to default. That I've often said that high RS screen. If I could only have one, that's the one. You lock me in a prison cell, but allow me one screen. It's that one because I just want to see where the money's been going. Now. You make a good point, though, about, listen, as money rotates, are you willing to try other names? A name that comes to mind, something like Wynn Resorts that broke out last week.
Right.
and we were highlighting that. Well, there's a name that if you look at the weekly, it had this nice little pivot, but then you had this big base. Well, it's lower RS for a reason because it's been in this giant base. So I'm willing to go, well, am I willing to consider it? Sure. And if I do think, well, look, money's got to rotate somewhere, where else is it going to potentially go? So if we start to see this as a theme, and we talked about the Russell a little bit, being, the proverbial head fake machine over the last number of years. We think the Russell's going to really lead for a little while. And we've had a little bit of outperformance relative to the NASDAQ over the last few weeks, but I don't even care if it outperforms. It's just got to get it involved for there to be real opportunity. And that would be a great spot. Well, any of these stocks, because you look, the Russell's been in this big base since the peak in 21. So there could be a lot of bigger bases. The question I'm looking at is, look, if we start to see action like we saw in a Wynn Resorts or in these bigger bases where the RS is a little bit lower, but money's clearly going there, or we see that as a theme. Right now, it still looks like a little too early to tell. And even, this Russell's now run up. It may need to digest for a couple of weeks here. I'd love to see that. And then coincident, I would expect to see a lot more buyable merchandise. The percentage of stocks even above their 200-day, if you were to study this even compared to other prior cycles, is quite low, which tells me there's been a lot of stocks that don't even meet the long-term uptrend criteria yet. So we could see a whole host of those names join the party, but I would expect them, at least initially, if you're just going into a new uptrend, to probably be a little lower RS. So the devil's going to be in the details in terms of just the quality of the setup and the quality of the base. But that would be a very positive development.
One area that we can maybe finish up on, and I've been playing this myself too, the cryptocurrency, whether it's with IBIT, I do still have a position in this. It's been a little tricky because it's been below its 50-day moving average line for a little bit over a week, but depending on where you got it, again, I kind of trade on the chart here. I don't know anything about crypto, I'll be honest, but I can read a chart, and that's kind of helped me. So between the Bitcoin or the Ethereum ETHA, I'll just put up as and I do have a position in this. What are your thoughts on these? Is it kind of beginning or?
Yeah, for the record, I have positions in both as well. And you look, I'm bullish technically and fundamentally, but look, I'm not going to hang on when the technicals start to sour. That we start with IBIT. I mean, listen, that base breakout back there in July is really classic. Now, we are bordering on failure of that breakout here. Depending on how big of a stickler you want, some people would already say it's failed because we've closed below the 50, but we really just sort of retested that breakout. So, and the way I've been handling this is just trading around a core position for quite a while, and then trimming down to a size I'm willing to hold.
What's quite a while for you?
Well, I was buying this. If you go back to the weekly there, and we were highlighting this in real time on the platform right as it was coming off those sort of lows in March of 24 there. Initially, and then I was buying it aggressively there, de-risked some into that move, and then held a portion through the pullback, re-added. I got chopped around a little bit in that big base, re-added prior to the breakout there, de-risked some into this move, into the move higher, and sort of trying to I added aggressively, then again, coming out of this most recent breakout, and then have since reduced as some into profits and then some kind of near break even. I was buying there as it was coming out. So I'm just sort of back to a smaller core position. And if this sort of really close meaningfully below, say, weekly below 60, I'm kind of using one of the recipes we have on the Minervini 360 platform to backstop bigger moves for the last portion of the position. So I'm trying to give at least, and I'm writing a winner here, not sticking with a newer position. So I still think, obviously I'm holding it, so I'm talking my book a little bit, but I still think it's hasn't failed completely yet. So willing to give that last piece the benefit of the doubt. I mean, look, this has been, if the momentum in some of the tech and those type of areas continues to work into the end of the year, I would expect this to do well. But I am not a Bitcoin maxi or stick around for these big declines. And
Right.
even if you were to study Bitcoin going all the way back, when I was first looking at the market was in 2014, 15, you'll see it goes through the same periods. It has large uptrends and downtrends, but then sets up bases. You can't see it with you got the GBTC all the way back there. This one's a little sloppier, but yeah, it's had multiple spots or times where you could potentially get on board. So listen, if the trend breaks, I'm gone for the last position or last portion of the position. The ETH or ETH A or ETH E, depending on which one, is really kind of a high tide flag here. And this is where I was buying a little bit sort of a couple weeks ago and was hoping it was going to tighten up more. So this is where right around the 1st or 2nd of August, I was buying before it gapped because I don't like to chase gaps. And I was hoping I could get, right in that little low cheat right there. I was hoping it was going to tighten up a little more. But I was, and this is occasionally how I'll do things. So if something's a little short, but I really want to own it and it's not perfect, I'll be incremental, put on a partial part of the position. And it can sometimes be very small, just sort of a placeholder, but then I'm always looking to add or increase my position if the setup increases. In this case, I got on a small piece. It took right off. I sold a portion, de-risked that part, and now I'm sitting with it. And today I was actually adding a little bit back because I'm sitting here going, now, if this momentum is still good, the lows of this week or last week should hold. So it looks a little sloppy here, but if you look at it on the spot chart, this is where crypto's a little bit funky.
Yeah.
And it's also tricky because some of these ETFs, they follow pretty close, but you can have some gaps. At least in the ETF market versus the spot market. So crypto, as everyone knows, trades 24/365. So you got to be mindful of that, certainly if you're not going to trade the spot market. So position size accordingly. But I like it. Obviously, I own it. I think this is where the momentum in the crypto area has been. I know supposedly there's ETFs and other things coming that are providing a tailwind here. I'll leave that to the fundamental guys to argue. To me, I like the price action. It looks like it's in strong hands to me.
Yeah. Well, Mark, it's really great having you on. Again, I think this is one of those things where everyone has their times where you're looking at all the lanes going faster, whether it's in the grocery store or on the freeway, whatever, put your analogy wherever you want. And I mean, look, the poker players, right? Sometimes you get this upstart poker player that, comes from online and knocks out all the big guys, but you tend to see the same poker players at the final table all the time. So again, there's a system that they have. They know that things aren't always going to work their way. It's an odds game. So I think what you were saying about that kind of patience, knowing your numbers, knowing, that it's not always going to be great. And again, making sure that you're doing what's right for your system as opposed to, oh, am I doing as good as this other system with this other set of rules and everything. But any parting thoughts? Because again, I think your optimism here is something that I think a lot of people need in terms of that stick to it type thing.
Well, listen, you really nailed it there, at the end in terms of just understanding that you need to have that in your mind ahead of time. That how am I going to handle periods when either I'm out of sync or my strategy's not working or both, because that's an inevitability. This is, as my dad would say, this is what you signed up for.
Yeah.
So knowing that, count the cost ahead of time, and then giving yourself all the tools in order to manage those periods. So listen, and again, simplify and sort of, we kind of see like our office sometimes like as if there is an echo chamber, we want it to be here. Like, what does it look like for it to be vacuum packed in here so that we're not influenced by everybody else? Easier said than done. I understand that. But so that at the end of the day, look, you call me next week and you're like, man, I am crushing it. Man, awesome. But that's not, is that going to dictate my tactics? Oh, I got to get bigger because Justin's having a good run? No. And you would never do that in other areas of your life. Yet, for whatever reason, markets have this way of seducing people into those kind of decisions. And that's just what you want to guard yourself against. And listen, I'm sure we'll be talking at another point in the future where things are going great. And I'll be happy to share that too.
Right, exactly.
Because I've lived through both. And listen, anybody who tells you that you're not going to have tough times or tough days in the market is somebody you want to run, not walk away from, in my view.
Yeah. Well, and for kind of more of Mark Ritchie's wisdom, you can go to, again, X. I think you do some really good posts there that kind of put things in perspective. That's at Mark Ritchie _ the second. So I will do it for you, the capitalize. Yeah, wonderful having you on, Mark. Always a pleasure. Thanks for, again, sharing your wisdom with so many people. Really appreciate it.
Justin, always good to see you. Always good to be on.
Yeah, thanks a lot. That's going to wrap it up for us this week. Thank you so much for watching. Join us next week. We're going to have Eric Kroll back on the show. He, of course, is one of the authors of the Life Cycle Trade. And we're probably going to be digging into some of his market statistics. He and I are going to actually do some collab work, I think, so we can get some good research out to you. He's done some great work on the length of extensions and rallies. So we'll definitely dive into that next week. So we really hope you join us. That's going to be Wednesday, live at 5. See you then. Take care, everybody.